Let's do it. Hello, everyone. Thank you so much for joining us today. This is such an exciting session. VGEC, as everyone probably knows, is free money. We all love free money. So this is not boring tax stuff. This is exciting, money in the bank, money into your studio, really important stuff. And it's really important, I think, to understand the differences between VGTR and VGEC because there are many and some of them are quite complicated. So I'm going to run you through this presentation. If you've got any questions along the way, pop them into the chat box. We'll probably try to cover most of them at the end. But if it's something really pertinent, we can pick it up on the way. But just in case you're not sure who I am, my name is Catherine Davis. I'm the founder of Urban Ledgers. We are a chartered accountancy practice. We specialize solely in the games industry. So all of our clients are in the games industry. And as far as we know, we're the only UK accountancy practice that has that niche. So obviously, we can help you with all your compliance work. VGTR and VGEC claims are a specialism of ours, and also we can act as an outsourced finance team. So that's a little bit about us. Just to give you a flavour of some of our clients, you probably recognise some of these names. We work with studios of all sizes, from startups through to Series B and beyond. But let's get to the main event. What you need to know about VGEC right now. So obviously you're probably aware that VGEC has replaced VGTR. This is for new projects that start development from the 1st of April 2025. And what that means is if you have a new project that commences development post that date, VGEC is going to affect the funding, the compliance, and the timelines around your claims. So we're going to walk through this in detail. There's going to be a lot of information. So yes, any questions, as I say, feel free to pop them into the chat. So let's just have a quick refresher. VGEC versus VGTR. So VGTR was a legacy tax relief. It fully ends in March 27. That's its sunset date. So from that date, you cannot claim under VGTR anymore. As I said before, VGEC's coming into force from the 1st of April 25 for new projects. And why did the government bring this change? There's a couple of major reasons. One is the implementation of Pillar 2, which is a global tax policy. And of course, the government are keen to boost skills domestically, drive UK innovation, and therefore they've changed the relief to only include UK spend instead of previously UK and European Economic Area spend. So there's some key differences here, some of which you may be aware of and some not. In terms of the rate, and I'm talking here an effective rate. So under VGTR, the effective rate was 20%. So as an example, if you had 100,000 spend on your game, your effective claim value is 20% of that, so 20,000. So under VGEC, it's gone up a little bit more. It's now 20.4%. The way that it's calculated and the way that it's included in your tax return is quite different to the way it used to be. I'm not going to go into detail about that because it's very confusing, but just be aware that the way that it's included in your tax return is different, and your accountants need to understand that. In terms of the spend that's eligible, so previously you could include both UK and EEA spend, but now it's strictly UK only. So that is a massive impact on so many studios that have got, subsidiaries in, Europe, for example, or they've got US teams, whatever it might be. This is a massive, massive change. And again, with the subcontracting limits, VGTR previously had $1 million per project cap, and that $1 million project cap was across the entire life of the project. So it's not $1 million per year, it's $1 million for the entire project. That's got some pretty serious implications for bigger projects. With VGEC, there's no cap. That's been removed now. So with the minimum amount of spend that you have to incur before you can claim, VGTR previously, you had to have 25% of your total project spend in the UK and EEA combined. Under VGEC, it's 10% and it can only be UK spend. So they've decreased that a little bit, which means that if you have operations in the UK predominantly, this is great news. It may be more preferential for you to claim under VGEC. but we'll get onto that shortly. Connected party screening, you've probably heard a lot of talk about operating through an SPV. Can you still do that under VGEC? Are HMRC going to open inquiries into any company that has, related party transactions and they're claiming VGEC or VGTR under those subsidiary companies? There is more scrutiny, and we're definitely seeing it through HMRC. It was there before under VGTR, but now under VGEC, they've recognised formally that, of course, there are these vehicles that are being used to claim VGEC and VGTR, and they want to make sure that the companies are transacting at arm's length. So it has to be a realistic transaction. It can't be a completely fabricated markup, which apparently HMRC was seeing before when they opened up inquiries. They were seeing some fabricated 100% markups between companies, which is just ridiculous. So they're making it very clear that they're clamping down on that. But in reality, it's nothing heavier than it was under VGTR. It's still a realistic requirement. As long as you're not taking the Michael, then they're happy with that. And we'll talk a little bit more about that later on. And the cap on the qualifying spend. So what this means is under VGTR, you could claim up to 85% of the costs on your project. Under VGEC, you still have that 80% cap. So nothing's changed there. So talking about timelines again, I mentioned that you must adopt VGEC if your development started post 1st of April 2025. But for projects that were already in development before the 1st of April 25, you can still claim under VGTR if you like. You can optionally adopt VGEC now if you wanted to, but you don't have to. So for those projects already in development, and you may have been claiming already under VGTR, that's fine. You can continue to do that. Or you may have been claiming under VGTR for that project, and you now want to move to VGEC. Absolutely fine. You can do that. And interestingly, where you've got multiple projects that are being run under the studio, you can choose to run some under VGTR and some under VGEC. And there might be different reasons why you'd want to do that. For example, if you have a co-dev partner outside of the UK for one of your projects, it might be more beneficial to claim under VGTR still because it includes the European spend. So that raises the question, what is the start of development? So the start of development is really when you've already got that initial concept in place, you've got the design in place, and you've got that green lit internally. So it's not some sort of vague idea. It has to be a concept that's, you can evidence the fact that it's been refined. There's going to be a target market. There's a point of difference, et cetera, et cetera. It's going to be commercially viable, and you've got the green light to proceed. And what we would always suggest is document this internally as evidence that the project started before the 1st of April 2025 if you want to claim VGTR. That's really, really important, because if your project started post 1st of April 25 and you've got a lot of European spend, then obviously you can't claim that under VGEC. So we could be talking tens, hundreds of thousands of pounds difference here. So it's really important to make sure that you've documented when the project starts. And if HMRC ever wanted to look at that, you can then go back to that documentation and say, well, this is what we did up until that date. This is when we decided it was feasible. And this is when development started. And that development must be before the 1st of April 25. So let's talk about the impact of the UK only spend. As I say, VGTR's European Economic Area spend, VGEC isn't. So where you've got teams around the globe, and more common than not, it's in Europe, you cannot include that spend under VGEC. But there are some exceptions to that, which I'll talk about shortly. So what this means is you have to plan your resource allocation really carefully. It may be that under VGEC, you decide to recruit more staff in the UK. You might decide to utilize UK co-dev partners to maximize that claim. But whatever you do, you have to keep a clear audit trail of who worked where and when. And I'll explain a little bit more about that in a minute, because that's really important. Because it moves us on to this point about used and consumed in the UK. so much grey around this. It's a really quite complicated point. And we've had some clarification from HMRC about this. There is a bit of a, I guess, misunderstanding that it's black and white. So a lot of studios think that now you can only claim costs in the UK. You cannot claim costs that are incurred outside of the UK, for example, for overseas workers. That's not strictly true. So the way that HMRC interpret this is if you've got somebody, for example, based in the US, they're doing some development work for you, and that development work then feeds into the UK development team's work, and they expand on that, or they work using those principles. Something like that would be deemed used and consumed in the UK. So it's originated from somebody outside of the US, but it's work that is then brought back into the UK team, and they've done further work around that. They've enhanced it, manipulated it, whatever it might be, but they have worked with that. It's not a end deliverable that's been provided to the UK company. It's something that feeds into the development process by the designers and the programmers. So that would actually be eligible. It'd be deemed as used and consumed in the UK. But, and this is the converse of this. So if you have a overseas contractor, for example, or company that are doing a piece of work that's standalone, or it just slots in as a piece of the overall development, and it's not further developed by the UK team, then that is not deemed to be used and consumed in the UK. So it has to be manipulated or used by that team in some way. It cannot be a succinct and identifiable part of the development. So that's important to think about, where you've got your co-dev partners that are often responsible for producing a number of aspects of the game and delivering the end product. So in those cases, that wouldn't be allowed. But if you've got subcontractors, and particularly one-man bands, or you've got individuals based in the US or Europe that are doing artwork that's then refined by the UK team, as an example, then yes, that could potentially be allowable. So what does this mean practically? It means it's a little bit of a headache, I have to say. So what we would suggest that you do is, for every team member that you have, or every company that you work with that's feeding into your development process, you need to analyze that to ascertain exactly what work they're delivering. And is that work further developed by the UK team, or is it just standalone and it slots in as a development piece? And what we'd say is just keep a schedule of all of that, include their remit, and just make it crystal clear as to whether or not it's used by the UK team and how it's used by them. Because HMRC will potentially look at this, particularly if those contracts are material, and particularly if those contracts are with a company that's known to be either a co-dev or delivers, end pieces of development, parts of the development process. So you've got to be really careful that the contracts that you have in place with the companies and the individuals that sit outside the UK, reflect clearly your understanding of their remit, as in, is the work going to be used by the UK development team, or are they standalone? And the contracts have to reflect that. Because if you go to HMRC and you say, well, actually, this company's work, we changed it to become X, Y, and Z. But if their contract says they're going to deliver this piece of work end to end, and there's nothing further that the UK developer will do on that, then that puts that into question. And HMRC are going to be interested in this because it is grey, it is complicated, and when you've got staff all over the world, it's tricky. So keep those records, make sure those contracts are clear, and just think about what the UK team is doing. I guess it's good news, because I think originally there was a lot of thought in the industry that only UK costs by UK resources would be able to be included. But you can see that if your UK company is paying for resources, or companies outside of the US, outside of the UK, then it's possible that those costs can be included too. which is good news. So just talking about subcontracting limits for a moment. So as I mentioned before, they're gone under VGEC. Previously, there was 1 million. Just to touch on that a little bit, and a bit of a common misconception here is that all contractors, even a one-man band, falls under that subcontracting limit. That's not actually true. So you have to look at the nature and the spirit of the agreement. Generally, what we find is the one-man bands or an individual contractor does not fall within that because they're, again, doing work that fits into the overall development, but it's further worked on by the UK development team. If, however, you have a co-dev partner, then clearly that's going to fall within that subcontracting limit under VGTR. So just be a little bit careful there that, you know, somebody's scrutinizing those contracts for you, and whoever is doing your claim, make sure that they understand what each of these particular subcontractors are doing, because you could be missing an opportunity there to include their costs in your VGTR claim. Obviously, VGEC, no issue there. There's no subcontracting limits whatsoever. But, of course, the work has to be used and consumed in the UK. So talking about connected parties, so really, really important that the intercompany transactions have to be at arm's length. So if you're transacting with a company in your group, you should have evidence of the charge out rates between each. So that could be in the form of a transfer pricing agreement, development agreement, something like that, that basically says, for this price, you are going to get this. And that's the agreement. And behind that, you need to support why the pricing is at the rate that you set. It cannot be fictional. It cannot be 100% markup, which is obscene. You have to benchmark it against, for example, if you do work for hire, what is your rate card for other studios for work for hire? It has to correlate with that. It has to be supportable, realistic, and it has to be evidence, because more often than not, if a HMRC inquiry is raised, and we see this numerous times, they will come back and say, how do you support that rate? Where is your evidence to support it? And it's going to change depending on where the studio is and whether they have staff that work remotely. Are they overseas? Are they in London? Are they up north? It's going to vary, but the more evidence that you can keep around these rates, the better. And of course, now under VGEC and since 1st of April last year, actually, there's a new additional information form which has to be submitted with both VGTR and VGEC claims, and it's asking about connected parties. So it wants to know, who are these parties in your group? What is the spend with these parties? And it's really bringing it to the forefront with HMRC, because previously they didn't ask that at all. So they want to make sure that they're aware of what these connected parties are, who they are, what are the transactions that are happening between them, and they may want to delve into that a little bit. So let's talk about SPVs for a moment. So first of all, for those who don't know what an SPV is, it's a special purpose vehicle. It's a 100% owned subsidiary of your company, of your main company. And the way that it works is the main company employs staff. It then lends those staff to the special purpose vehicle. The special purpose vehicle then acts as the development company, and it charges your main company a fee, generally with a markup of around 10 to 20%. So those two fees offset each other. No one ends up with a profit or loss. And what it means is that you're able to uplift your resource costs paid by the development company, and that development company is getting the benefit of an extra 10 to 20%, say, of costs that it can then claim on. That's probably one of the main reasons that an SPV is used. Other really great reasons are, it's pretty simple to run a project discreetly through an SPV. It keeps it nice and clean for accounting purposes. It simplifies everything. It strips it out separately from the revenue and other costs in the main company, the non-project related costs. And probably one of the best benefits of using an SPV is you can change the year-end date quite easily to allow multiple claims per year. So it's easier to change the year end of an SPV, which is your development company, and claim twice a year, 3 times a year, whatever it is that you like. It's much more difficult and complex and expensive from an accountancy fee point of view to change your main company, because every time you submit a claim, obviously you have to prepare a set of accounts and a corporation tax return. If you're preparing that for an SPV, it's much more cost effective to do it for that SPV rather than the main company. The main company is always going to be more complicated. So we touched on the additional information form, which requires more details of the qualifying costs, the connected parties, all that sort of good stuff. It makes it pretty clear to HMRC what it is that they might want to delve into. Really important point here is that it has to be submitted before the corporation tax return is submitted. So if you submit your corporation tax return that includes a claim, but you haven't submitted your additional information form, then HMRC will just reject it straight away. They won't look at it. They'll ask you to submit that form and come back. And that's pretty frustrating. If you're cash strapped, you're waiting for that claim, you're waiting for the HMRC clock to start ticking in terms of their processing time. If something isn't submitted correctly or at all, then that means that time frame is going to start again. And sometimes you've wasted 20 days, 30 days sometimes before HMRC have looked at it and said, sorry, that's rejected, try again. So let's talk about pre-release claims. So this is obviously where your game's not in early access, it hasn't been released at all. Can you still claim before that release date under VGEC? Yes, absolutely. So you can still get your interim certificate at any point. Still a great way to support runway during development. And we would always say, get that interim certificate as early as you can. I think at the moment, the BFI are taking around 12 weeks. So it does take a little bit of time, but get that in your pocket as soon as you can, because if you suddenly have a runway issue, which obviously can happen at any time, you've got that flexibility then to put a claim in at that point, and you know more than likely that cash flow will then hit your account maybe 1 to 2 months later from HMRC. So it's important to keep an eye on your runway, keep an eye on when you can and should claim under VGEC or VGTR, just to prop up that runway, because it's a great tool to have in your arsenal just to ensure that you're not going to run out of cash. So talking about cash, payouts from HMRC, how long do they take? So their target at the moment is 40 working days. It used to be 28, it's now 40. They've actually beefed up their team a little bit, although most of our clients probably would say it hasn't made much difference, unfortunately. But they have beefed up their team, and they are beefing up the number of inquiries that they're opening. And when studios adopt VGEC, they will look into those more, for sure. So they're bolstering up their team at the moment in readiness for that. But a question we often have is what happens if an inquiry is open? So I think first thing to note here is don't panic. It happens. We see around 10 to 15% of our claims being open for an inquiry, and sometimes it's just a couple of rounds of questions from HMRC asking for further documentation. We see it happening where there's an SPV in place, which is fine. It's all, as long as the agreements are in place and it's all, excuse me, defensible, absolutely fine. It's just a process. We're seeing it more when it's a first claim for a studio. HMRC are a little bit interested in that point. And I suspect we'll see it more once we start claiming through VGEC as well. So in that case, when an inquiry is opened, HMRC normally send a letter around 50 or 60 working days since submission, and then a round of queries could take 3 to 6 months to clear. So that's going to have serious implications on your cash flow. So I would suggest, if you are putting in your first claim, do not bake that VGTR or VGEC money into your cash flow, because it is possible that HMRC will open an inquiry. And as I say, if it's through an SPV, it's even more likely they will open it. Not because they're suspicious of it, but it's just they want to make sure those transactions, particularly those intercompany transactions, are all above board and they're all at arm's length. So just be aware of that not all claims are going to be paid out within 40 days. HMRC can have a look at it. So I'm just going to run on to a slightly different section. So these are tips for both VGTR and VGEC, which I hope you find helpful. So I touched on before shortening the year end with Companies House. You can absolutely do that. You can do that as many times as you like. So that means you can make multiple claims in a year and prop up your runway that way. Just remember, it's a cost-benefit analysis. So if you obviously have to prepare accounts and a tax return for each claim. If your claim is tiny, you might find that the accountancy fees might outweigh that. There might not be any benefit. But for larger companies, not even larger studios, but as long as you're not a micro studio, there is almost always a benefit to claiming multiple times within the year. So just something to be aware of there. So what about abandoned games? I mean, this is a really interesting point. So of course, in the last few years, we're seeing more and more abandoned games, sadly. And you can claim on those. And what would have been happening is you would have been claiming through the development cycle on an interim certificate. So more than likely, obviously, it hasn't been released. If you have received VGTR money, you don't have to pay it back. So, which is a huge relief, obviously, to studios that have had to close for whatever reason. And you also don't have to apply for a final BFI certificate. So yeah, just rest assured, you're not going to have to pay that money back. So who can claim for VGTR and VGEC? There's no de minimis. Any studio can claim. So as an example, if your studio has only incurred 20,000 of costs, under VGTR, you can still claim back 4K. Under VGEC, slightly more. So just be mindful that you don't have to have spent 100 grand, 500 grand, whatever it might be. It can be just the tiniest amount. And for a micro studio, that could be the difference between closure and success. So talking about red flags here. So if your game contains any sort of gambling or payout mechanics, then that's not going to be certifiable by the BFI. And this is really important where you may have been developing a game and then it's pivoted slightly and you've included a gambling element to that. At that point that you've pivoted, that's going to be ineligible for VGTR. So be really, really careful. And when they're talking about gambling, they're talking about winning prizes that have a cash or a cash equivalent. So it could even be, it could be by skill or chance. So you might set up a game based on chance. Somebody wins a t-shirt. So that t-shirt it can be converted to cash. So at that point, that game becomes ineligible. So just be really, really careful of that. Similarly, if you have related party transactions and you do not disclose them, the claim will be invalidated. Also, if you don't submit your additional information form or your BFI certificate and also your cumulative project profit and loss, your claim is going to be rejected initially. And as I mentioned before, HMRC, you've probably already taken 40 days to get to that point. Then they'll come back to you and say, well, you need to resubmit. That clock starts again. That 40 days starts again. So you do not want that when your runway is tight. And another one, this is really interesting actually, and not that well known. So costs that are not physically paid out at your year end, nor are they paid out for the next 4 months after year end, they cannot be included in your claim for the current year. So just say, for example, you had directors' bonuses that you're accruing in your accounts. 4 months after year end, you haven't paid them, but you've included them in your claim. So those costs are not actually eligible. So it has to be, those costs must have been paid out within 4 months of your year end. Otherwise, you cannot include them in your claim. So just moving on to VGEC and same with VGTR. So if you've got a right to claim VGEC and VGTR, that's hugely valuable for investors. So again, another good reason to apply early for an interim certificate. Obviously, it props up your runway, and you can use VGTR and VGEC as collateral for a loan. So if you are going to go down that path of getting lending against your VGTR or VGEC claim. So there's a number of lenders that do it. Banks do it. There's specialist lenders as well out there. Of course, they've got certain criteria that you need to meet. Generally, they will lend over 100,000 if the claim's over 100,000 in size, but we're seeing that reduce for some lenders. Ideally, they want to see that you've successfully claimed before, or where you haven't claimed, or where you have claimed and there's been an inquiry opened, that inquiry has been closed successfully. Cost benefit analysis here is really important. Lending against these VGTR and VGEC claims isn't cheap. Sometimes it's absolutely essential. You just need to weigh that up. Is this going to be worth it? And often it is, because you're propping up the life of the studio. So for some studios, this is a great option because it means that they can keep their team on, they can keep developing, they get that cash in the door earlier. And sometimes we see these loans being used if an inquiry is about to be opened, but we're very confident that it's going to be closed and it's going to be paid out in full. So if an inquiry is open, the studio knows it's going to take 3 to 6 months to close out potentially. And at that point, a lender might step in and say, well, we recognize the risk is low, that you're not going to be paid out. So we will lend against that, which is essentially a lifeline, particularly if you're talking hundreds of thousands of pounds in money that you're waiting for from HMRC. So let's talk a little bit about record keeping. So it is super important, obviously, to keep your project costs tracked and keep it up to date. And the main reason for that is, well, one, if you ever want to run project costs, you can do so from your accounting software. But also, if you decide you want to suddenly submit a claim, then everything's in order, it's ready to go, and it's going to be a lot easier than trying to scramble around. Particularly if you're using spreadsheets, would not recommend that. I mean, all of our clients use Xero, which is great. And it also allows project tracking as well. But obviously there's other software out there that does similar things. But most importantly, keep it up to date, keep it reconciled, keep it really clean and tidy. As I mentioned before, track your staff locations, track what their roles are. What are they actually doing? It may be something different to their role title. They might have been taken on as one thing and they've moved slightly into another area, particularly if they move into marketing or something like that, which is ineligible for VGTR and VGEC. So keep track of where they are, what they're doing. Make sure your agreements are in place. So this is not just intercompany agreements, this is publishing agreements, etc., particularly co-dev. And they have to be reviewed. Those agreements, where they're impacting the VGEC or the VGTR claim, they need to be reviewed every time you're submitting a claim. And the reason for that is more likely than not, they include a rate that you can recharge or that you're charging from the development company to the main company. You have to make sure that that rate is reviewed so that it's not exceeding a specific markup, because it can get out of kilter a little bit. If it's sort of more than 20% or so, you need to look at that and just think, is it getting too high? Is it getting unrealistic? For co-dev arrangements and publishing agreements as well, just make sure it's really clear in the contracts which party has a right to claim, because only one party can claim VGTR. There can only be one video game development company. So you need to be crystal clear as to who that is, because obviously there's a significant monetary impact for the claimant. So make sure that's in writing. So a few final thoughts. For projects in development pre-1st of April, you have to think really carefully about, do you want to move to VGEC now? So it is a huge decision. Sometimes it's really easy. It's clear cut because all the operations are in the UK, all the spends in the UK. It's simple. It makes more sense to move to VGEC. More often than not, though, there's some nuances or complexities where you've got staff based overseas. Almost always there's non-UK contractors, subcontractors that are involved in projects. Most studios operate a global team. So there's a lot to think about. So the reason that's so important, I mean, we had a new client that we took on actually about a month ago, and they came to us and they'd had advice that from the 1st of April 25, they have to move to VGEC. They absolutely had to. There was no option, which was wrong. There was the wrong information that was given from this generalist accountant. they had operations in Europe. They had subsidiaries in Europe. And by the time we ended up looking at it, reanalyzing it and reassessing it, they would have lost over £1 million in monies if they had gone under VGEC, which they were all set to do, which is it was crazy when you think about it. So just be really, really careful that you're getting the right advice. You understand what the differences are between the two. And I think also you need to think about the agreements that are in place. Could they be tweaked possibly to be more VGTR friendly, possibly? A lot to think about, but there's certainly ways of staying under VGTR and means to achieve that. As I say, obtain that BFI certificate early. It gives you flexibility. It can prop your runway. It can save your studio. And of course, get help. There's a lot of lawyers as well that specialize in the games industry. They are really, really key. I would just say, just be really careful if you've got a generalist accountant. Just be really careful. Make sure they know what they're talking about when it comes to VGTR and VGEC, because it's obviously very specific and it has a lot of gray areas. So please, please, please do get some advice. And equally, if anyone wants to reach out to me on LinkedIn and have a chat, completely free, obligation free, I would be more than happy to chat through your specific circumstances and just perhaps brainstorm, is it going to be better to move to VGEC now, or is it better to wait until March 2027? And if you're interested, we've got a newsletter that goes out roughly each week, which contains just tips and tricks about VGEC and VGTR, if that's something that you might want to sign up to. And that leads me on to questions. So we've covered a lot in the session today, and I hope you found it helpful, and I hope that there was some new information there that you haven't heard before. If you've got any questions, feel free to pop them into the comments box. I don't know if you can raise your hand. I'm not sure if Leo can see that.
People can definitely raise their hand. Anonymous questions as well, if you'd like, you can pop them in the Q&A box. We do have a question actually. I was actually going to not to take any thunder away from this question asker. In terms of sort of full-time employees from the UK, working remotely in various countries. So in this example, they've had a full-time employee who's been working remotely in multiple different countries for sort of 3 months. Apparently going to return to the UK shortly, but where does that sort of digital nomadery sort of land with VGEC?
Yeah, well, I think if they're on payroll in the UK, then you can almost certainly say that they are UK spend that's eligible. There's only a certain period of time you're technically allowed out of the country and still be domiciled in the UK for tax purposes. If they're sort of moving around, I dare say if it's an individual, that work will then feature within further development work within the company. But if they're on payroll, almost certainly they will be able to include those costs in the claim as a UK employee. If they left the country for 6 months plus, then I think you'd have to apportion the time potentially. If they were doing standalone work that wasn't fed into the game and wasn't further developed by the UK team. So if they're delivering a finished element of the game from the US, for example, for a 6-month stint in the US, then I think you would have to exclude that time. But anytime they're in the UK, yeah, absolutely fine. But again, you have to consider, is the work they're doing when they're out of the UK able to be fed back into that UK team and used in the development?
It's good to know. I hope that answered your question. Fantastic. We don't have any other questions. I just wondered sort of if you see any sort of particular trends afoot, maybe where things are going sort of in the future, perhaps. Obviously, VGEC's still relatively new, but are you getting any sense of any changes that might happen at any time soon?
Well, I think there will definitely be more clarity around this used and consumed rule, which is so difficult to put into practice, I think. So I think there will definitely be more clarity around that as more studios adopt VGEC. I mean, for us, almost all of our clients are still using VGTR, but we're starting to slowly see the transition for new projects that have just started after the 1st of April. Obviously, there's no choice. But in terms of the industry moving forward, I mean, at some rate, we would hope that there's a higher VGEC rate that's applied to micro studios. That's a hope, and I know there's already lobbying around that, but it's going to take time. I mean, the government's only just recently introduced VGEC. That's a massive change for the industry, and I don't think they're going to be really keen to change that for a little while. But fingers crossed that does happen at some point where, you know, it brings it in line with other creative reliefs where those smaller studios are getting a higher rate of relief, which would be amazing to see.
Absolutely. Fantastic. Well, that's really, really helpful to understand. We've had a couple more questions come through on the Q&A box. I don't know if you can sort of see them yourself, but had one here. How are the intercompany changes deemed paid in terms of 4-month after period end rule? I'm not too sure I quite grasp that. Does that make sense to you?
Yeah, it does. It does. And sorry, I can't see the questions for some reason in the chat.
That's okay.
How are they deemed paid? So normally with those invoices, they offset each other. So if they don't offset each other, then a physical payment between the two entities is fine. And generally the two entities will be in a VAT group, so there won't be any VAT implications of making physical payments. More often than not, though, the payment between the two entities net off. So you can do an accounting entry in the main co to settle that invoice as paid, and it's paid against the, you know, the other side of the invoice. You know, you've got a payable and a receivable there. Both of those would be net off together and marked as paid. So once they're marked as paid, they're deemed paid. No cash had to move. And in fact, HMRC had a question about that for one of our clients probably about 6 months ago, and they periodically raise it again and again, you know, show us that this has been paid. And our response to that is it doesn't have to be physically paid because they net each other off. So there's no point moving money from one bank account to the other because those transactions net each other off. If they don't net off for whatever reason, then I would suggest settling those quarterly. And even with amounts that do set off, raise those invoices quarterly and settle them quarterly in your accounting software to show that they have been paid.
No, that makes a lot of sense. Thanks for that. That's helpful. Sorry, I completely misread that question, I think. So for going back to sort of smaller companies, micro studios, maybe solo devs, one employee, company director, doing both sort of contract work for other companies, but also working on their own internal projects. You know, this person's asked if there's benefits of trying to claim VGEC and VGTR, assuming that it can only be put towards their own internal projects. I'm assuming that is the case.
Yeah, exactly. And we do see this a bit where, I mean, particularly in the current market where you've got people that are contracting out to other studios, but they're also developing their own IP. So where they're developing their own IP, they can absolutely claim for that. Absolutely. But you just got to be careful with the costs. Any costs that are associated with your consulting work cannot be included as spend within the project. So you have to, you know, demarcate which costs relate to the project itself and which ones relate to your consulting. And I'm guessing probably not that many costs relate to consulting. So it should be pretty clear cut that most of the spend would relate to the project, and you can definitely claim on that. With the caveat that, of course, you have to get a BFI certificate. You have to meet the BFI certificates criteria, or BFI's criteria, I should say.
Yep. No, that makes a lot of sense. Tremendous. Well, I will. I think we've come to the end of our sort of questions now. But I'll absolutely sort of put your details up on the video at the bottom and everything, and we can definitely get in touch there. You've got your email address. Tremendous.
That'd be great.
Thank you so much, Catherine.
Absolute pleasure. And as I say, if anyone wants to have a chat, completely obligation-free, cost-free, just reach out. I'd be more than happy to help. The more money we can get in for the game studios, the better.
Absolutely. Fantastic stuff. Well, thank you so much, everyone, for tuning in. Appreciate it. There's more to come in this series. We've got the whole of May sort of packed out. So please do take a look at the links on Eventbrite and everything. And hopefully see you at another one very soon. But until then, thank you so much.
Thanks, Leo.